All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market has about 2 hours left here in it today, and it's been an interesting day in the market. Few interesting things here this morning. We have the ECB, who's basically European Central Bank, basically saying, "Look, there's trouble out there," and and they're acting, and it's one where it's making investors, look and go, wait a minute, are we a little over exuberant here, to the upside when it comes to things? And and the answer is, yeah, if there's a global recession, right, and we're a long way away from that, but if there is a global recession that happens, right, we will see the S&P break the lows from December. Very easy. Right, we're not talking about something where, oh, okay, you know what? If there's a global recession, the market will pull back 10% and kind of retrace the recent rally. No, it will make the sell-off that we have seen in October, November, and December look fairly small. Right, that's what it will do, and it's one of those where we can speculate about a recession and all of that, and the reality is there's a lot of factors and there are a lot of variables that that contribute to something like that, and that dominoes that would need to fall for something like that to happen. There's some dominoes that need to fall for something like that not to happen. And, any of those dominoes could fall, going forward. But, the ECB definitely has the market looking and saying, okay, that risk factor is out there. So we're seeing a little bit of pullback, down 0.7% here on the SPY. One of the interesting things about today, and, we talk about the small cap, large cap, performances, but here's the IWM minute chart. And the IWM sold off with the rest of the market this morning. And then the IWM went green, outperforming the SPY. The SPY never went green. It was still at its high, down 12 points or something like that. Went green. And then as the SPY was kind of going up, IWM was starting to bleed on down lower. And IWM's not at its low for the day. Small cap's not at their low for the day, but pretty close. So it had this kind of early on outperformance that, kind of suggests, hey, you know what, the rest of the day market could, carry on higher, but then really starts to fade off here. And, started doing it even as the S&P was not on the decline. So we see that coming in here this afternoon. And, the reality is, the small cap underperformance versus large cap performance, it has switched. And if I come in, we looked at this metric yesterday, this performance metric here with the SPY and the IWM over the last 30 days. You can see small caps now over the last 30 days are lagging large caps. Right, that they've switched, and it's one of those where it's not a dramatically bearish situation in terms of small caps lagging large caps. There's not a 2% differential, which tends to be that kind of hey, bears are in control number. But, if we just zoom this in a little bit, to something like 7 days, you can see it's more than 2%, and so the bears are or almost 2%. Sorry, so the majority of what the bears have captured in this dynamic is over the last 7 days, and in fact, I believe if I come in here and just put last 5 days, it may be a little bit worse over the last 5 days. Let's go last 3. Yeah, I mean, last 3, about the same dynamic. So, the reality is, bottom line, I mean, we are seeing some erosion there. If we look at things like the bullish percent index, this has held up phenomenally well, but this is going to be the worst day for the bullish percent index since December. And you go, well, it's only down 1.8, and you're right, it's only down 1.8. This isn't exactly a all aboard, bearish train here. And what you generally need with the bullish percent index is a 6% pullback to trigger bearish, right? And it's not there. It's not happening, right? Bulls are still in control of it, but it is, the worst erosion that we have seen in it, in quite some time, right? In quite some time. Now, one thing we're also seeing that we haven't seen all year is the number of stocks trading below 7 and 20-day moving averages, both pushing into bearish zones. Number of stocks trading above 7-day moving averages, only 20% of the S&P is above its 7-day moving average. This is a very bearish number. This is a number that bears absolutely have control over. We looked at it earlier this week, and they didn't, but they have taken control of this short-term number in a big way. But the one that's harder for the bears to take control over after a rally like what the market has had in the last 2 months is the number of stocks trading above the 20-day moving average. And you can see that it's 39% of the S&P 500 is trading above the 20-day moving average. That means more S&P 500 stocks are trading below their 20 than above their 20. That is a big erosion. That is a big drop in that number. And, this is a number that was up around 80% just a week ago. Right? So, this is a very quick, very fast move here in terms of the number of stocks moving below the 20-day moving average, and, has gone from kind of that neutral territory at the beginning of this week into, square on bearish territory now. So we are definitely seeing an erosion, when it comes down to, things. If we come in and we just look at something like the advancers versus decliners, right? The NYAD, number of stocks advancing versus declining. This is now 2 days in a row where the decliners are going to outpace the advancers, by a sizable margin. We haven't had 2 days in a row like this all year. Right, we haven't had 2 days in a row of this nature all year, and so a little more weakness, yes, a little more weakness than what there has been, absolutely. And here's the NYUD, and you look at the volume, right? The accumulation of volume, advancing versus declining volume. We definitely have more downside volume in the market today than we have had on many other days, and the volume element of the of the market vibe is turning bearish. And this is the first time in a long time that it is turning bearish, and that is, that is something that I find to be very noteworthy and very, very important as far as analyzing the market as we go forward. Let me kind of put this in the right, visual context here. There we go. But here we have the it's a cumulative chart of the NYUD. So it's basically taking the volumes, aggregating them, day by day. And then there are some lines in here, 5 lines in here. The middle line is just a 20-day moving average of this. And then, the other lines are moving average envelopes. And you can see that we've gone from in this area that I'm going to shade in here, this is considered strong bull territory, right? The part that I've shaded in yellow is strong bear territory, or excuse me, bull territory. This area that I'm shading in here in pink is strong bear territory. Okay, and anything in between is pretty neutral. You can see that we've gone from now a long period in strong bull territory to even overextended bull territory. When it gets outside that moving average envelope, it's very overextended. And it has spent some time in that area, especially in January, February. But now it's pulling into this bearish territory. It's not really resting in the neutral territory. The volumes in this market are, eroding and eroding at a very fast pace, and they're eroding quicker than what the indexes suggest, right? When you just look at the pure price action on the indexes, yeah, they're down, but the volume element is actually down further or more negative than what the pure price element is on the S&P. So this is enough right now where the market vibe has turned bearish, and it is flashing a fresh bear signal here today. Now when we see bear signals come in on the market vibe, it is common to see the next day or two up, right? We oftentimes will see that. It just doesn't mean, hey, every day is going to be down. But we have seen now a shift in the metrics. The metrics have shifted. Not all of them, right? Bears don't have control of all of them, but this is the most control the Bears have had the entire year. And they've wrestled it away fairly quickly. It's one of those where it did go into a neutral, and they are pulling them down. It's not the quickest kind of reversal, but that's what we're seeing out there right now. And so that does set up some whipsaw risk, obviously, for the Bears. That hey, it could whipsaw back up. We see the market vibe jump a little bit. We can see the bulls resume control rather quickly, but as it sits right now, it's definitely, in the Bears' hands. Okay. Now, as far as some signals coming into the market, we do have some Katie signals, coming into the market here today, and there's a lot of 3-7 downside crossovers in the S&P 500 today, where the 3-day moving average is crossing down below the 7-day moving average, which, we have seen this kind of erosion taking place over the course of this week. But today, there's about 14% of the S&P that has this kind of downside 3-7 action coming into it. For example, in Apple, the 3-day moving average is crossing down below the 7-day moving average. Now, this isn't a Katie signal. The consolidation risk is too high, but, we are seeing it here with Apple. The 3-7 crossover. We're seeing a downside 3-7 crossover with Microsoft that is coming in here today. If you got the alert earlier before I got on video, I did go grab some Microsoft puts here for the challenge. If you want to see, why, well, one is a downside Katie signal, and two, if you look at the hourly, we got the bounce right back to the 7-hour moving average, and then start to weaken off the 7-hour moving average. So I use that as an opportunity to get in, and am going to run with that here on Microsoft. But has that 3-7 action coming in. We have Wells Fargo, within the bank group that has some of that coming in. But the banks aren't having the same type of erosion. But Bank of America, J.P. Morgan, they had some of these 3-7 crossovers earlier this week. And J.P. Morgan, just looks absolutely targeted for 100, and kind of looks like almost a no-brainer down. It goes to 100 here with J.P. Morgan. But even some of the financials that have held up well, like a Visa, has a 3-7 crossover. Coca-Cola, ironic today, Coca-Cola has a 3-7 downside crossover, and Pepsi doesn't. Right? Pepsi got the downgrade. Coke was a neutral. Yet Coke has the downside crossover here with it today. But we see this kind of 3-7 action coming into some of the big names, the Amazons of the world, that are seeing it. We're seeing it in some of the healthcare, like Abbott Labs, ABT. We're seeing it in some of the energy, like Noble, NBL, and we're seeing it in some of the industrials. And I went out and I priced some puts on Honeywell, here today. And I was like, okay, I really like the chart. I really like the setup. I like the hourly, and Honeywell was down about $1 at the time. And I'm pricing out the options. And if we come in and we look at them, you're going to see if I go to next week's, the options have a 10% spread. Ugh. I know Honeywell options typically have a spread, but, middle of the day, they're still at a 10% spread. It's not uncommon to see Honeywell at the end of the day with a 15 to 20% spread and at the open with a 15 to 20% spread. But, typically that comes down in the middle of the day. But it's not. For Honeywell, it's not for some of the other lower volume industrials. UTX, you can see the spread, very high. Triple M. You can see, these are stocks that I've traded for the challenge before because, their spreads have come in. Triple M's have actually come in here in the last little bit, so they're actually not too bad right now. But we do have some expansion of spreads, that's starting to happen out there. But, all these stocks with that 3-7 downside crossover action, Phillips 66, Costco, McDonald's, Mattel, just to name a few that still have that same action here today. In fact, me, McDonald's. I'm very bearish McDonald's. I think McDonald's has a long way to fall, and a stock that's been propped up on borrowed money. And in so many ways, I think it's the one of the best examples of a company out there that has borrowed and borrowed and borrowed to push their stock price higher and grown the debt on their balance sheet to push their stock price higher. And, you say, well, hey, other companies do it, and you're right, they do, and they have. But McDonald's has done it to a really strong degree, and it's something where, debt's one of those things. Everyone, debt's terrible, debt's this, debt's that. Well, no, debt, there's a reason that, people, when they start a business or, that type of thing, they go out and they get into some debt, right? Because they can make more money on that money than, what it's costing them to service that debt. And as long as that happens, you make more money on that money you borrowed. Hey, the debt's not a big deal. What is a big deal is when you stop making money, or you stop growing your earnings and can't service the debt. And, McDonald's isn't in that situation yet. But I do believe some fears of that could start to come into play, if we do see a little bit of a global downtick, from an economic standpoint here. So, one that I'm watching definitely has some short-term bearish price action in the stock and, has that 3-7, downside crossover action associated, associated here with it. You look at things like Valero, it had a 3-7 downside crossover back here about a week and a half ago, and it's continued on lower. It's not been an easy, an easy hold, right? If you're in Valero puts, it's been chop, 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 chop. But ultimately, that 3-7 trend is emerging, and we're seeing that, across the board out there in the market. Even in the financials, like at JP Morgan, where the 3-7 crossed, back when I got into the puts, and, it wasn't an easy hold, right? The next day, big gap up, boom, then, okay, sells off, and then the next day, gap up, and boom, and then sells on off, and, it's been kind of wild, but those 3-7s have ultimately held, here in the market. Okay. So anyway, those are some of the things that are happening out there here today, in the market and with some of the stocks out there. I put about half the challenge money into play. I'll be looking to put the other half into play, before the close today. But I'll be very, very picky. It's not something that, the market's a little oversold short term, ultra short term to want to go 100% all in, to the downside. But we'll see how things shape up as we get closer to the close here today. Again, thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.